Hi there. Thanks for tuning in. Today we're going to be doing an analysis and valuation of the Molson Coors beverage company. So let's get started. And what does Molson Coors do? Well, they have a big portfolio of core brands. There's the Coors and the Coors Light. Those are US beers that are very popular. There's Molson, which is a Canadian beer if you know it. There's Carling, which is a UK beer, which is very fun. And then there's Ojushko, I'm gonna guess, which is a Croatian beer. So they have a portfolio mainly in North America and then a little bit in Europe and the rest of the Americas. So that's basically what they do. They do beer, they do other beverages too, however. Right now they have Simply Spiked. So that's fun. So they do have a few other beverages that are both non-alcoholic and also alternatives to beer, for example. We know that things like spiked fizzy drinks are growing a lot, so they're putting their hands in that pie to see if they can get a piece of it. I think that's smart enough. Those are growing probably way quicker than beer, so if they can get a little bit of market share there, because that's always very fragmented, then that's a smart choice. Now, I want to tell the financial story of Molson Coors now. And if you look at the long term here, it's very, very interesting. The reason why, so if you'll see here, their revenue used to be consistently around 4 to 5 billion US dollars a year, and then all of a sudden spiked to about double that. What happened here? Well, in late 2016, they acquired Miller Coors from Bev. So basically, they acquired a big company that doubled their revenue. But I want to also note this next bar, the net income, and this other bar, the free cash flow, where you see revenue double, but then you see net income stay almost the same. That's crazy. So if you tell me, hey, I made this product and I got $100 from it, and after paying for everything that it costed to make this product, all the people I had to pay, I kept 20 bucks. Okay, so your margin there is 20. I would say cool. But if you tell me, hey, now I sold 200, but I still only got 20, I'd be less impressed. I feel like I'd have questions. I'd be like, what exactly happened there? And part of the explanation is also this. Look at how much debt they had to take over. So they went from having not even $3 billion in debt to now close to 11 billion. And they've been working it down, granted. And I think credit where credit is due, all the way from 2016 till now, their debt has shrank significantly. Great job, people at Coors in the finances who are trying to pay it down. That's a great news. But also, this is a stratospheric jump. And at the end of the day, part of your income from operations has to go to pay the interest and debt. And then another part of your free cash flow probably pays down some principal. So part of the reason why net income is still lower, besides 2020 for obvious reasons, is because they have struggled with this amount of debt. And you see here that even though this acquisition doubled their revenue, it did not double their income, and it actually more than quadrupled their debt. So, not all acquisitions are great. The Miller Coors acquisition was not the best in the world out here, even though it expanded their portfolio. So, that's something to note. That's something very interesting. So now for near-term news regarding debt, Molson Coors was upgraded to triple B from triple B minus by Standard and Poor's. So it does seem at least that credit agencies are looking at it, and triple B minus is basically the border between something that's considered quality and trash in terms of debt. So it seems like they have some better times ahead because they're continuing to deleverage to pay down that debt. But we will have to see. So lately, in this first quarter, they actually managed to increase the revenue. They managed to increase income before taxes. Earnings per share are up. Free cash flow is down a little bit. That one I don't like to see as much. Net debt is down though. That's great. And their dividend is up and their shares repurchased are up. So that is amazing. However, their outlook was not that positive, and that's something that we'll see reflect in the share price a little later. But for now, what you see is that their cost of goods sold is up in general. Why? Because of inflation. That's what they're saying. They have some volume leverage, some mix shifts that are unfavorable, and inflation that's also not favorable because their manufacturing and materials costs are higher. So, as you see, inflation is affecting everyone from consumers to companies, and they're not entirely always able to pass that down to the consumer. When you have a very competitive space, such as beer, I think them raising prices is something that they're not as flexible doing. They can't say, okay, we're going to raise the price of each of our beers by $1 because guess what? The other guy has beers $1 cheaper. So, in a very competitive space like this, you have less flexibility to up your prices. Now, capital expenditures, you have 144 million for the quarter. This is about in line. They reduced their net debt. That's awesome. And their dividend was up 7%. And they repurchased 1.8 million shares for a total of $110 million in the quarter. So that's awesome. They are returning money to shareholders or to prospective shareholders, at least in the long run. So their guidance here, as I was saying, they're basically saying we're going to grow from at low to mid single digits. So they're being a little conservative here. A lot of companies are saying we're going to grow in those mid to high single digits, maybe even low double digits. Miller Coors is basically saying, or Molson Coors rather, is saying, hey, not yet. So they're being a little cautious, even though they beat expectations for the quarter. And I think that's fine. I think that gives us a very conservative assumption to make. So I'm going to make a discounted cash flow model here based on those assumptions. They say free cash flow is going to be 1.2 billion plus or minus 10%. I'm going to make it about this, which is basically about 10% of the revenues, maybe a little less, which is in line with what usually happens. So this, I'm going to grow it a little bit in 2025, then keep it flat for 2026, 27, just to account for potential pains. Then I'm going to grow Molson Coors by a perpetual growth rate of 2% per year in perpetuity, basically. Now, I have a required rate of return of 11%. That is 1% more per year than the market has historically given. I like that number because it compounds to be quite a lot. Now, if we divide that by the total number of shares out, we get a fair value of equity of $58.05. However, if we subtract the net debt, which we saw was quite a lot, the value post debt is of $29.84. So this is quite the differential. We're talking pretty much halving the price here. So that's something to note. Now let's see where the price of Molson Coors has been. And I want to show just the all-time graph because I think it's super interesting. Because look, I mean, if you were a shareholder from the beginning, from the genesis of this stock or this company being public, you would have done amazing all the way up to 2016. And if you sold here, you are super happy you got 4 digits percentage return rate at the very least. Now you see that they suffer. And this, what happened here, the Miller Coors acquisition. And then you see that everything here becomes a little more complicated, culminating in 2020 for obvious reasons, and then a slow recovery. Although lately you have this downtrend, this is because the outlook was more conservative than people expected. Okay, so the story here is very interesting because here we see the story of an acquisition with a lot of pains attached to it. Molson Coors still feels the pain from the debt acquired, and while they've been working the debt down, it just really still hurts the valuation, at least if you care about it. It's great that they've had their credit rating upgraded, so they're able to re-roll the debt into more favorable terms, hopefully. But at the end of the day, while they have that much debt and they're not earning near that amount of debt, it's not a great outlook. However, the growth is really respectable. They have historically grown free cash flow at an okay rate, although not an amazing one. Even from the acquisition, revenue has stayed pretty flat overall, but free cash flow generation is still consistent at least. So they always will have money to do things, to buy back shares, to give a dividend, which they do. So you do get a return. I don't doubt it will have value in the future, but right now it only has a dividend of 3.43%. Are you willing to be paid that amount on your cost to just wait for it to eventually pay down the debt and then grow? I don't know. I feel like there may be better opportunities in the market right now where I am willing to just put my money there and then look at Coors later on and say, okay, now they're doing better. Now they've paid their debt down. Maybe now is the time to hop in. So look at the whole picture. Here, it's more important to just zoom out past the quarterly results, past the yearly results, past the last 3 years, which is usually what you see in the annual reports, and look at the last 10 years because you see why they have so much debt, and how it's gone wrong. So look at the whole picture for every company you analyze and see, compare it to the peers and see if it still fits your strategy. I hope you learned something from this video. I thank you so much for watching. If you want to see more videos like these, don't forget to comment which companies you want me to analyze. And don't forget to like and subscribe. Thank you so much for watching and have a great rest of your day.